Today we're going to look at QAI, which is a liquid alt. It's the biggest liquid alt in the ETF universe. And by liquid alt, I mean that it's an alternative. It gives a hedge fund style strategy, which is non-correlated to the market, which people like. And it's liquid because unlike hedge funds, you can get in and out whenever you want, hence liquid alt. So QAI is a pretty big liquid alt at over $1 billion, charges 53 basis points, and it really wants to track a multi-strategy hedge fund index. That's what you're getting here. Now, how does it do it? What does it exactly hold? This is where it's interesting. Some liquid alts directly invest like hedge funds. Other ones do what QAI does, which is to do hedge fund replication. It does a regression analysis, and it uses other ETFs to imitate the return of that hedge fund index. So that's how you're that's what you're holding, and what you're getting is that return. Now, how is it performed? You hope that an alternative would buffer the market drop, and in the last 2 weeks it has. Like this one is down, I guess, just about 2%, but way better than the 7% drop in the market. The thing with QAI is it does have a little beta in there. It's got a 72% correlation with the market. Some hedge funds have 0. So the question with any liquid alt is how much hedge do you actually want in your hedge fund ETF?
And that's a question we're going to ask to Sal Bruno, Chief Investment Officer of IndexIQ. So Sal, is QAI a true hedge fund, or is it a watered down version of a hedge fund?
Well, what it tries to do is to identify the factors that are driving hedge fund returns, and as Eric mentioned, to get to those exposures through other ETFs. So when you look at a correlation of, say, a 0.7, that's actually in line, in fact, a little bit lower than the correlation we see for other broad-based hedge fund indices. So it very much gives you the risk and return experience that you would get with the broad hedge fund index by doing it through the ETF wrapper.
What do you benchmark yourself against?
We look at ourselves relative to a fund-weighted, or the HFRI FOF, the Fund of Funds Index. And our performance has actually tracked that fairly well over the time period that we've been live.
Now, I get a lot of questions about M&A. That's the merger arb ETF. I think that's the third biggest one. Every time there's M&A, people are always like, can you talk about the merger arb ETF? Just explain that this isn't holding acquisitions before they happen. Just explain how this thing does its thing.
So because it's a passive ETF, we go through a monthly rebalance cycle. So at the beginning of each month, we run screens and identify only companies that have had a deal announced where they're a target. So it's not trying to speculate on which deals may be announced, but those that have been announced. And it goes in and tries to buy positions in those and capture the remaining premium. What makes it a little bit unique is instead of shorting the acquirer, like most typical merger arbs would do, we actually short the sectors of the acquirer using liquid ETFs like the SPDR ETFs to try to protect some of the downside that may be impacting sort of broad factors that are driving the returns in that particular sector.
Now, the goal of alternatives and alternative investing, of course, is uncorrelated returns, which was probably a bit of a hard sell over the past couple of years when global stocks just kept zooming higher. What kind of interest are you seeing this month now that we've got this return of volatility for QAI, for M&A, now that volatility seems to be returning and perhaps maybe here to stay? We're not sure yet, though.
Right. So we've been having a lot of conversations on QAI, even more so on M&A. So M&A has almost tripled in terms of assets over the last 13 months. So we started out the beginning of 2017 at about 140 million. We're over almost 420 million now in M&A. So a lot of conversations there. It tends to have a beta of around 0.15 to 0.2, correlation to the equity markets of 0.5, and negative correlation to the Barclays Aggregate Bond Index. So we've had a lot of people finding it as a really interesting way to diversify both equity risk and the risk of rising rates.
Now, you have an ETF with a ticker that's just very relevant this week, CPI, right? It's the real return ETF. I would have thought it had more assets. I think it has like 20 million. Oh, what does it do, and why hasn't it been more of a hit?
So similar to QAI, it's also an ETF of other ETFs. I think part of the reason we haven't seen as many of the assets flowing in is we've been in a very low inflation environment kind of since we launched the fund back in 2009. So people have not shown a whole lot of interest in trying to hedge inflation. It's based on some research that we had published in the Journal of Portfolio Management that basically challenges the notion that tips and gold are the only ways or the best ways to hedge inflation. You should really have a core position in the short-term instrument like treasuries, money markets, et cetera, with other satellite positions and other inflation-sensitive assets.
Very quickly, does the return of volatility excite people, get more people talking about this then?
Absolutely. We're fielding a lot more calls, a lot more client interest in terms of talking about things like M&A and QAI as ways to cushion some of the downside in their portfolios.